Okay, looking at Chapter 5, there are a few things I want to talk about before I actually get to Problem 2. One is I just want to kind of highlight things that are in your textbook about the balance sheet that I didn't specifically assign anything over it because it isn't actually quantitative, but more qualitative sort of things about the balance sheet. But just like the income statement, you need to understand, why is it useful? So you can see I've kind of highlighted some things out of your book on page 214 of your textbook. Analysts would use the balance sheet to assess liquidity, solvency, and financial flexibility. So the balance sheet's very helpful. And then, the book's going to talk about all three of those. Liquidity is more of a short-term thing. It's the amount of time until an asset is realized. We call in accounting, this word realized means converting something to cash. So until an asset is converted to cash, a lot of times that's just because you're selling it, or until a liability has been paid. So that's usually liquidity is a very short-term sort of thing. So being able to assess that. Solvency has to do with being able to pay debts as they mature, and financial flexibility is the ability of an enterprise to take effective actions to alter the amounts and the timing of cash flows. And, again, we have looked at, the purpose of the financial statements to be able to project the amount, timing, and then, of course, the risk of those future cash flows. And so this is getting back to the income statement helps us determine that, and so does the balance sheet to help us assess those items. There are some limitations to the balance sheet. One is that most of the assets are reported at historical cost. Well, if you've got a building that's 30 years old or 40 years old, how meaningful is a 30-year-old number on the balance sheet? Well, probably not very. So that's one of the downsides. The other one is that, estimates are used, like accounts receivable. We also have the allowance for doubtful accounts. That's an estimate. Or physical assets. We have the accumulated depreciation account. That also is merely an estimate. So we don't have so those are not clearly defined what those numbers will be. There's a ballpark figure. It should be reasonable, but again, what I arrive at an estimate may be different than what somebody else arrives as an estimate. And then it may omit items that are of value. And the typical one is employees. Employees are expensed, right? Employees are expenses, but then most CEOs will go around saying the employees are their strongest asset, but the accountant doesn't record them as an asset. So the pros and cost benefits of the balance sheet. And then the last thing as well on this is knowing, just like by now you should know the definitions of the items, the elements on the income statement, and now here in Chapter 5 you should be memorizing these elements for the balance sheet. So the assets are benefits, they're economic benefits, and they're going to be future economic benefits. It's not certain that we'll get them, that's why it's probable that they will occur. And they're a result of past transactions. So the car that the company owns is a result of a transaction in the past of when we purchased the car. So we have the car because we bought it previously, but it's going to give us future benefits because I'm going to continue to use it in the future to get around. Liabilities are sacrifices. And it's something we're going to sacrifice in the future. It's not a sure thing, so that's why it's probable. So there are going to be future sacrifices of our assets, right? Future economic benefits. And again, these are a result of past transactions. It's already occurred. So I have, a note payable. That's because I might have borrowed money, maybe 2 years ago or sometime in the past. I borrowed money, and so I still have that liability on the balance sheet. Equity is a residual interest. So that's just taking, it's the residual interest of taking our assets minus our liabilities. We get a residual, and that's stockholders' equity. Okay, so knowing those definitions. All right, well, let's switch gears and get out of here and move over to problem 2. If you haven't attempted problem 2, please go do that before you watch the rest of this recording, because I'm actually just going to look at the solution and talk about the solution. Okay, And by the way, if you have not noticed it, I want to bring up one other thing before I actually talk about this. If you haven't really looked at, on page 253, this demo problem at the end of the chapter, this is very good. It doesn't have actual numbers, but just, all the various classifications on the balance sheet for the assets and the liabilities. What are the accounts and stockholders' equity? This is nice. It has all of those that we just kind of ended in chapter 4. We kind of ended that chapter looking at comprehensive income and talked about these 4 categories: the common stock or contributed capital area, retained earnings, accumulated other comprehensive income, and now also this chapter is adding in the negative or contra stockholders' equity count, right? It's negative, but treasury stock, and you would have had that in a prior course. Okay, so that's, if you hadn't noticed that, I wanted to bring that to your attention because it's worth earmarking that for future references. Okay, so here we have problem 2, and I just kind of want to talk about it some because we have these different categories for assets. Current assets. Well, you have to understand what the word current means. So your textbook's going to define current assets. Any of those are going to be used, sold, or converted to cash within 1 year or 1 operating cycle, whichever is longer. Well, in the past, you may have focused on, in your lower level courses, that current assets are something that only exists for a year. But actually, there's more to it than that. The current asset might actually exist longer. We might classify something that's going to be around longer than a year because the operating cycle is longer. Well, let's review, what is an operating cycle? So operating cycles, if you think about it, we purchase goods. And then we're going to turn around and sell those goods. So we sell the goods, which is going to usually create an account receivable. And then eventually we'll collect our money. And then, it kind of starts all over again. We purchase the goods. So we purchase our, didn't turn out very well. It's supposed to say goods. Make that a little clearer. So we purchase our goods. We turn around and sell those goods on accounts. We get account receivable. Then we're going to collect our money, and then the cycle starts all over again. So you have to wonder, well, what kind of good or product would take longer than a year for all of this to happen? Well, there aren't very many of them. One that comes to mind would be, if you construct very, very large buildings. So, a skyscraper. So if you are a contractor who constructs a skyscraper, those often take a couple of 3 years, sometimes longer, to build that. Or a huge ship. Those take longer than a year. So if you have if you're in a unique industry like that, then your current assets are going to be assets that will be around longer than a year. They'll be however long your operating cycle is. So again, you've got to compare 1 year with the operating cycle. The large majority of times, 1 year is the longer. But again, there's our exceptions. So just want to make sure you're aware of that. The other thing I kind of want to talk about really are the values on the income statement. On the balance sheet. Switch gears here. So, this idea of cash. Again, your textbook talked about cash and cash equivalents. So cash equivalents are those investments, that only last, they're going to mature within 3 months. So if you have an investment that will mature within 3 months, you're going to put it in with cash and cash equivalents. Then we have other short-term investments, equity investments, and I want to point out that this concept of value, we would report, investments get reported at fair value for both of those. So fair value. So cash equivalents or these equity investments, those are going to be reported at their fair value. You may want to go back to Chapter 2 and review that concept. I think it's on page 57. But your textbook goes through, there are 3 levels of fair value. Fair value can just be a market value. So it could be like if these equity investments, if it's equity, that means stock. So we've got an investment in stock. Well, if those are publicly traded, I can just go to the Wall Street Journal and find the market value. That's the top priority of fair value. But what if I have an investment that's not publicly traded? Well, then we'll go to the second tier. That's where we have like investments. So there we have, an investment that's just like, or an asset that's just like another asset. And so, we're just looking to see what it's worth. So sometimes I think like used equipment and, the idea of blue book value, if you know about blue book values for cars, I might go, so if I've got a car that for some reasons are an asset, or if the car is valued at fair value. But if I wanted to know the fair value, not that the car gets reported at fair value, but if we wanted to know the fair value, we could go to the blue book value, that's a publication, and see roughly what it might be worth. So fair value is when there's similar assets and we know the value of a similar asset, we can use that to report it on the balance sheet. And then the third layer for fair value is when, there's not a quoted market price for our particular asset, and number 2, there's not a similar asset. So then you get into discounting the present value of the cash flows. And we haven't gotten into that concept. We'll look at that in Chapter 6. But that's the third layer of looking at what's that asset, what kind of benefits or cash flows will that asset project in the future, and we'll kind of use those to value the asset. But anyhow, the first 2 layers, you should be able to understand those. So if you don't, go back and reread page 57. Notes receivable is reported at net realizable value, just like all notes or accounts receivable. So I know it wasn't an account receivable in this problem, but accounts receivable often are reported here in current assets, and those are at net realizable value, the net cash value. What do we really expect to collect? So it's accounts receivable less that allowance account. So less the allowance for doubtful accounts. So same thing with income tax receivable. So the receivables are reported at net realizable value. Inventory gets reported at the lower of cost or market. You might remember that from your prior financial accounting course. So we compare cost with market value, and whichever one's the lowest, we report inventory at that to be conservative. Prepaid expenses are at cost. So we can already see, even with just the current assets, that really not all assets are reported at the same value. We have different ways of reporting them. I listed here these long-term investments. There weren't any in this particular problem, but I want to jump down to and look at one of the pages in your book, page, I thought I had it up. Yeah, page 221. And it looks here at where's that? Page 221 looks at long-term investments. So there's a lot of different things that kind of can go in here. There's 4 categories that your authors broke it out in. Investments in securities, and that can be debt debt securities or equity securities, so bonds, common stock. Could be tangible fixed assets. Usually the fixed assets are property, plant, and equipment, but if those are not currently used in operations, then it's not property, plant, and equipment. So again, land held for speculation. We don't know what we're going to do with it. We consider it an investment, not an operating asset. Okay, or if we have assets set aside for special funds, like sinking fund, pension fund, plan expansion fund. That I wasn't sure if you would know what those were, so I wanted to talk about it for a little bit. A sinking fund is when we just set aside money, so we're going to put money in a fund to pay off a debt later on. So if we have like a 30-year note, and that it doesn't require monthly or annual payments, it's just going to become due in 30 years, Well, it could be that we're going to set money aside each year so that at the end of 30 years we don't have this humongous payment and that we haven't been working towards it. So a sinking fund is just money set aside, usually invested, so that it'll grow and be able to pay off a liability. Same thing with the pension fund. It's just money set aside so that when our employees retire, we have money available to pay their pensions. And the same with the planned expansion fund. We're setting money aside. This time we're not paying off a debt. We're just going to use it to buy something with. So this is really kind of a savings account, this planned expansion. We're setting money aside so that when we want to expand our plant facilities, we have money available to do that. All right, well, let's get back to our problem then. So that's long-term investments. Okay, property, plant, and equipment, these are our long-term operational assets. So these have to be used. Again, if it's not used in operations, it doesn't get classified as here. Again, it should be used in operations or it won't be classified as property, plant, and equipment. You'll sometimes hear me say PP&E, just to shortcut it. But property, plant, and equipment assets get reported at cost, historical cost. But then we also subtract book value. So they do get reported at cost, but then we net accumulated depreciation, and then that difference is called book value. Okay, so property, plant, and equipment at cost, and then it's related to book value. Goodwill likewise gets reported at cost, but then also we'll subtract out the accumulated amortization. Accumulated amortization. So we don't depreciate intangible assets, we amortize them. But the concept's the same. Amortization, depreciation is merely allocating the original cost over the useful life. Other assets, you might want to look on page 222 of your book. Goes over that pretty nicely. But, it's kind of, if anything doesn't fit into these other categories, you pretty much just put it in other assets then. Okay, let's move on to the next page. Liabilities. So again, the idea of a current liability, those are our liabilities that we're going to settle within 1 year or one operating cycle, whichever is longer. Long-term notes, usually there will be a note to the financial statements that will describe much of what this is. So those get described in the notes to the financial statements. And then stockholders' equity, we have our capital stock, we can have a preferred or common, and then this has the retained earnings account. But, again, I want to remind you there could be the 4 categories that I just went over earlier in that was in the textbook's demonstration problem. So make sure you're familiar with that. All right, well, that does it for problem 2.